After more than 2 years, the stock market has finally crossed its all-time high. Despite the weak economy, the market has grown by 6% in just a month and a half. How do stocks keep on going up and up when at the same time we are seeing massive layoffs, high inflation, and the highest interest rates in 15 years? Before we dive into the video, don't forget to share your thoughts and future video topics in the comments below. When we want to check the current status of the economy, some things we can look into are the employment data, inflation rate, and federal interest rates. In January, the total announced layoffs crossed over 82,000. All these jobs lost in a month was a massive increase from previous numbers in December, where we saw nearly 35,000 layoffs. This is an increase of 136% month over month. The finance industry announced over 23,000 job cuts, which was more than double the number from January 2023. United Parcel Service about 12,000 jobs, and PayPal is letting go 9% of their workforce. This wave of layoffs is not stopping here. Companies like Citigroup, Google, BlackRock, eBay, and many more have announced their layoffs for 2024. These massive layoffs might make you doubt the condition of the job market today. But what's the reason all these companies are doing mass job cuts? We can understand the cause of all this from this one chart. And yes, you are correct, this is the chart of the federal interest rate. See, before the lockdowns, things were pretty stable for both the interest rate and inflation. Rates were under around 2.4%, and inflation was about 1.8%. So companies during this time were running things as usual, but the lockdown changed things up. Suddenly, the rates fell to nearly 0%, and there were millions of people without jobs. During this time, the super low rates meant that business was booming for the financial sector. Everyone wanted to borrow, as they had the time to spend that money, and it was the cheapest the money had ever been. The other sector which was booming was tech. The lockdown meant that a decent amount of jobs moved from in-office to online, increasing the customer base for a lot of IT companies. The restrictions of being stuck in your house meant more and more people had to go online for entertainment, business, groceries, eating out, and so on. An increase in the supply of good workers with peak business years meant that both the tech and finance sectors hired in bulk. And why wouldn't they? Employers needed the manpower, and they had all the money in the world to spend on this because they could borrow it for practically nothing. This trend went on till mid-2022, and by then the Fed started to ramp up the rates to fight increasing inflation. As good as 2020 and 2021 were, the coming 2 years were unimaginably bad. Rates went to 5.3%, which is over 65 times what it was a couple of years ago. People saw the stress of inflation on their budgets, so we didn't go back to spending as much as we were in 2019. Business for the financial sector started to slow down as borrowing became expensive very quickly. Soon daily life went back to normal, so the tech companies didn't see the crazy spike in business they did in mid-2020. The companies had this massive workforce with reduced work and increasing costs to keep them employed. Because a lot of these companies have a high amount of debt, the increasing federal rate kept building pressure and increased costs month after month. Now, it is time for a lot of companies to let off the pressure built up over the last 2 years to survive. So, in the name of cost cutting, these two sectors are where we have seen the biggest layoffs. If the companies are struggling this much and the feds are not cutting rates, then why is the market skyrocketing? Well, the long period of increasing rates along with the Fed's recent decision to not cut rates seems to be working to solve the inflation problem. It's still nearly twice as much as in 2019, but is expected to decrease every month. The Wall Street Journal forecasts that inflation can fall below 3% for the first time in 3 years, which is a good sign for the future. On the other hand, while the market is still on the edge about the layoffs, recently Bureau of Statistics reported that the U.S. economy added 353,000 jobs in January alone. This number was well over the expectations and a lot higher than the 255,000 jobs added in January 2023. Unlike the layoffs, this job growth was seen across the board with some of the highest growth in industries like healthcare, education, and manufacturing, which I think says a lot more about the status of the job market than the layoffs. Inflation is decreasing, jobs are increasing, and the feds could be cutting the rates in the next 12 months. All these positive indicators were timed with a really big earnings season. Companies like Nvidia and Facebook soared when they beat the market's expectations and reported great earnings. Those are just two examples of companies that saw a massive increase due to good earnings and optimism from investors. It is important to remember that the stock market is not a representation of the economy. While the market can make quick moves every day, things happen at a very slow pace in the economy. It is better to see it as what the public thinks of the economy in the future, and looking at the great return so far, looks like all of us are optimistic. What do you think of the current situation of the market and the economy? If you enjoyed this video, then you will enjoy these as well. Thanks for watching.